Welcome to today's webinar, Low Dependency Investing, Satisfying the Regulator's Proposed DB Funding Code of Practice. My name is Rachel Pine, and I look after content for the PLSA's events and training. Many of you have been awaiting the proposal for the new DB funding code, which of course has been a bit delayed. Now, the Pension Regulator's proposed revised DB funding code of practice will put journey planning firmly on the agenda for trustees. Trustees will need to define a long-term objective for when their scheme is significantly mature and also a funding and investment plan to get there. Ultimately, this objective is to achieve low dependency on the sponsor covenant. But what does a low dependency investment strategy look like? Today, we're going to see just what the regulator's consultation document says about this, and we'll take a deep dive into credit-based and cash flow-driven investment strategies. We're delighted to be working with BMO again. They're an asset manager with more than 200 billion pounds in assets under management. They sponsored today's session for trustees and scheme managers, and they're offering their perspective as an LDI credit and fiduciary manager servicing more than 500 UK DB pension schemes. Our speakers today are Neil Bull, an investment consultant at the Pensions Regulator, and John Smith, BMO's Director of Solutions Development for Investment Solutions in the EMEA region. We're going to start with Neil, who's going to present for 10 to 15 minutes, and then we're going to break for a few questions for Neil specifically. After that, we'll hear from John, and then we've made sure to leave a good chunk of time to take questions for both Neil and John from all of you in the audience. Before we turn this over to Neil Bull, though, we have a polling question for all of you because we're interested in understanding if schemes are already starting to look at how the DB funding code may impact their investments. So I'm going to pop this up on the screen for everyone. And you can see it now. So who in the audience has already thought about their endgame asset portfolio for their scheme? Not thought about it, considering it, decided on it? Okay, so as you can see, 71% are considering it, 17% haven't thought about it, and 13% have already decided. So interesting numbers there, and I think this is a great time to bring in Neil Bull from the Pensions Regulator. Good morning, Neil.
Good morning, Rachel, and hello to everybody on the webinar. Thank you so much for inviting me to talk about the DB funding code, and hopefully over the next 10 minutes I'll give you an idea of the regulator's thoughts on this. Just looking at the poll, I think that's quite an interesting result. Quite a large proportion of the people certainly considering their long-term asset allocation, and we'll find out in a few minutes about sort of our thinking on that and what we're encouraging pension plans to do. So as Rachel says, my name is Neil Bull. I'm an investment consultant at the Pensions Regulator. I'm an actuary by background, and I'm the investment consultant on the working group that's developed the DB funding code consultation. Just to follow up on what Rachel said, happy to answer as many of your questions as possible. So with that in mind, I'll try to talk for less time and give you the opportunity. You can post them on the Q&As or ask those questions. I'll be delighted to try and answer them. Feel free to put your questions unfiltered. We grow a thick skin at the regulator. We're happy to try and answer anything you want to ask. Okay, so with that in mind, let's move on to the consultation. So there's actually two consultations we're issuing on the DB funding code. The first one of those has just closed at the beginning of September, and we're sort of busy starting to collate and analyse over 150 responses on that. For those folks that aren't as familiar with the consultation, we really wanted to focus the first one on kind of the big picture, big ticket items. So the principles of what we're trying to do, the regulatory approach, rather than getting into details in terms of the parameters and the actual numbers of that. And I think we felt that that was the best way, because some of these issues attract a lot of debate, and we wanted to bring all of that out in that first consultation. So the consultation document, all of these things are available on the Pensions Regulator's website. The consultation document is a pretty meaty document in detail. If you haven't read that, or you want kind of a quick guide, we publish that as well. That's quite a useful little reference guide that gives you a good summary of the key issues. And then we also published the modelling we use, the government's actuaries department, to help us with modelling, and that was particularly in relation to some of the low dependency asset portfolios. So if you really want to get into the detail, that modelling is available on our website as well. Okay, so if we move on to the next slide. So at the heart of our proposed approach in the consultation is this twin track approach of fast track and bespoke. And you might have heard of these words kind of banded around, and let me try and give you a little bit of detail about what they mean. Before I do that, of course, this all sits within primary legislation. We have a pensions bill that is going through the various stages of Parliament at the moment, both in the Commons and the Lords. And that continues to progress as MPs have now come back after the summer recess. In addition to that, there are regulations that will be put in place to kind of back up that primary legislation. And then we get into the code and the principles of the code. So that's really on this fast track and bespoke. So we do want to put in place a dual approach to compliance, and both approaches are equally valid. It's not like one is preferable than the other. So for fast track, we want to be clear with parameters. They're going to be prescriptive. And if a scheme satisfies those parameters, then there's a much lower level of evidence required and a fairly light touch from a regulatory perspective. Now, some schemes won't want to go down that fast track route, and they'll go through a bespoke, and that might be to do with particular circumstances of their scheme or their employer, or things that make them different, or they want to go down a different approach. And if that's the case, then that's absolutely fine. But clearly we will be requiring as a regulator a greater level of evidence. And those schemes should expect to have a greater level of regulatory involvement. So that's really the cornerstone of our approach here. Those two different options in terms of how schemes will comply with the new funding code. So let's move on to the next slide. This is the principles that form the main part of the first consultation. I'm not going to go through all of these principles in detail, but you can see they cover kind of the key areas we think are appropriate. The long-term objective that we're going to talk a bit about today, I think. The scheme investments, clearly that's relevant for today, but also a whole host of other things. How to set technical provisions, what about a sensible journey plan, how much one should rely on the employer covenant, and then other issues such as additional support from the company, open schemes and recovery plans. So lots in there, and these form the chapters of the original consultation. As I say, I'm going to focus very much in on the investment side, which I'll do on the next page if you may. So just looking at, if we move to the next page on investment. So the investment strategy principles, and I'll just read this out. I don't normally read out things from a slide word for word, but I think it's worth doing that here. So we expect the asset allocation for schemes that are at a point of significant maturity to have a high resilience to risk, a high level of liquidity, and a high average credit quality. So that is really about trying to get schemes in a good place and having that investment strategy to have a high resilience of risk. Now, of course, whenever we talk about risk, people have different measures of risk. And remember, we're trying to develop a fast track regime where it's going to be very clear what parameters are across all schemes. So we have to put a little bit more thought about how we define risk and where we measure risk from. So towards the bottom where we say we're seeking views, the reference point to measure risk from, for us, we feel that should be a measure of the liabilities. it's important, and we've seen in the last few years, that asset returns have moved around a lot, actually did quite well up until the sort of COVID crisis. But of course, bond yields have fallen, and that's increased the value of liabilities quite significantly. So unless we measure risk from an appropriate liability perspective, then we're only really looking at half the picture there. So that's an important point, and all of these points we're consulting on. In terms of measuring risk, lots of different measures around at the moment. People look at value at risk, a scenario test, asset liability modelling. It's important for us to have something fairly consistent across the board. So we believe the best way of doing that is through a fairly simple stress test. And in that stress test, it's effectively looking at a scenario where risky assets fall and bond yields fall. And lots more about that in the consultation, but it's important that we have a very clear, defined way of measuring risk so that it can be applied to all schemes, and schemes will know if they want to go down that fast track route, will they comply or not. And then perhaps the most tricky one of these is the acceptable level of risk. And this then starts to get into kind of the levels of parameters and the actual amount of risk we want. We've already said we want a high resilience to risk when a scheme is significantly mature. So we want that risk to be low by definition, but how low? We don't expect schemes to have zero investment risk, but on the other hand, we don't want schemes to have a high reliance on the employer covenant and that funding level to move around. So we put a few ideas in the consultation. We talked about a sort of portfolio that we use for modelling purposes of about 20% growth and 80% in matching assets. And under the stress test, that has around a sort of 3 to 4% fall in funding level. And we feel that sort of ballpark is about the right level, but clearly we'll read the consultation responses with great interest on there. From a cursory glance, we have some people that say that there should be much greater level of investment risk, and some people that perhaps say there should be less investment risk. And generally, when you get people replying on both sides, perhaps you've pitched it in roughly the right place. So then, separate from the investment risk, we do also want to look at liquidity and credit quality. And that's very important for mature plans, because mature plans are typically paying out quite a lot in benefits. We want to make sure that it's not just a mark-to-market funding level that we're stabilising, but also schemes actually need the assets realised to pay those benefits. So there's a number of different ideas on liquidity and credit quality in the consultation. I won't go through all of those in detail now, but perhaps we can pick some of those up in the questions. So moving to the next slide, this is just, we give the appendix, and then on the next page, we have a number of different ways of getting in touch with the regulator. Please don't be scared of the regulator. We are trying to develop a funding consultation in concert with everybody. As I say, all the documents are there. If you want to contact us, you can do with ideas outside of the consultation. The email address is above there. And there's a link for all of the documents that I mentioned at the beginning in terms of the regulators and the first consultation that we issued earlier this year and closed just a few weeks ago. So I think hopefully that's given you a little bit of an introduction to the way we've approached this from a regulator's perspective. Happy to answer any of your questions or clarify anything, and perhaps I'll hand over to Rachel to field those, if that's okay.
Yeah, very good. Thanks, Neil. Very interesting. While people are getting their questions ready, I have one for you. In watching your presentation, a thought occurred to me. Aren't you just really telling people to buy government bonds at a time when rates are at historic lows?
Yeah, so thanks for that question. I mean, it's an interesting question, and I'd be lying if I said I hadn't had that question on numerous times before. And I think the short answer to it is no, we're not. We're not forcing pension plans to invest in any particular asset class. I mean, trustees still have discretion to invest the way they want. And that's right and proper. What we are doing is looking at kind of the level of downside risk in the portfolio, and the proposed stress test allows us to do that. So it might be appropriate for some schemes to increase their allocation to bonds, particularly if they're very mature. But for the average scheme, we're still 15 to 20 years away from this sort of long-term, significantly mature point. So we've got quite a bit of time in terms of schemes to get into that point. So we're not sort of forcing a knee-jerk reaction. The second point I'd make is, if you look at the latest data on schemes, the average scheme has about 63% in bonds already. So we feel we're very much building on good practice that's already there. We do see schemes that continue to invest very significantly in growth assets that are approaching maturity, and quite frankly, we would be keen for those schemes to have a higher allocation of bonds and a greater resilience of risk. If schemes don't want to go down the fast track, as I mentioned before, they can go through bespoke. So it might be appropriate for a scheme that wants to hold a very large amount of growth assets to continue to do so. But then we'd be looking at some potentially contingent support from the company to kind of, backstop the risk if there's if the worst happened. So bespoke is a very flexible way of being able to comply with that, bringing other things into the picture like guarantees and contingent assets.
Very good. Thank you for that. Sorry, did you have more to say?
No, that's it, I think.
Oh, sorry. So got a question here from Kevin Crabtree. He says, our scheme is mature and large compared to the sponsor. We have a funding objective to look at some infrastructure investments that by nature have poor liquidity. What are your views on this?
Yeah, so that's an interesting one. I suppose I'll start off with my TPR disclaimer, which is I can't give you advice on a particular scheme, but I can perhaps, give some comments on the general question. I think it's important that a lot of schemes do use some infrastructure investments with kind of a regular income to provide that sort of matching asset class. I think we would sort of encourage that. I think that's an appropriate thing to do. But I think we want to look at the portfolio in its entirety. So if 100% of that portfolio was in infrastructure, I think we would have concerns in terms of the overall liquidity. I suspect, for Kevin's question, is that they have a proportion in infrastructure. And I think, I think that's fine and that's sensible. So difficult to comment without looking at the overall asset allocation. But I mean, infrastructure investments is something people use, and we wouldn't be against that particular asset class at all, or indeed any others, as long as it's done in a holistic way, I guess.
Very good. Thanks for that. I'm going to ask you one more question, Neil, and then we're going to introduce John.
Sure.
Bob Granger asks, can I assume that the regulator acknowledges LDI, liability-driven investing, as a matching strategy, and perhaps this is a much more sensible approach than moving into bonds?
Yeah, so I think first of all, we do acknowledge liability-driven investment. We see many schemes using that. That's actually something that we'd often want to encourage, particularly for schemes that have a high level of risk and that they can't support that. So I think LDI will absolutely form a place in this. And as Bob says, I think it can be a more efficient way of a scheme obtaining a better level of interest rate match than just in straight bonds. There's a degree of leverage in there. So I think LDI is important. It's not for the regulator to say it's better or worse than any particular other asset class, but certainly pension schemes that have used LDI to reduce their level of interest rate risk have actually done very well during or protected themselves very well during this COVID crisis. So that level of sort of integrated risk management is something we would encourage, and we'd certainly want the code to kind of encourage that use as well.
Very good. So we have time for more questions for Neil at the end of the session. But right now I'm going to bring in John Smith of BMO, who's going to tell us about low dependency investing. Good morning, John.
Good morning. Thank you very much. And thank you everybody for coming along. It's great to see so many attendees and some great questions so far. So I'll just flip over the slide now and just take you just as a quick recap, really. So what is it we're trying to achieve? As Neil says, as the scheme matures and ultimately reaches a point of significant maturity, which is defined by the regulator broadly as a duration of somewhere between 12 to 14 years, they'll need to introduce some sort of low dependency strategy. Now, for some schemes, that's going to mean buying out with an insurance company or maybe even something like a super fund approach. However, given the capacity constraints of these approaches, most schemes are probably going to be looking at some sort of long-term runoff strategy with their investments. And Neil was absolutely right that for the average scheme, that sort of point of significant maturity is a long way away. It's sort of 15 to 20 years. However, that doesn't mean that schemes can't start to take action now and start to think about what that low dependency point looks like, because schemes have to get there somehow, and they can either wait 15 to 20 years and move their entire investment strategy over at that point, or they can have some sort of journey plan that gradually eases into that strategy over time. And particularly for schemes that are slightly more mature now, maybe with a duration of sort of 16 to 17 years, that point of action may actually be now. It may now be the time to start thinking about gradually introducing that low dependency investment strategy. So in terms of the requirements, as Neil says, absolutely sufficient quality and security, an appropriate level of liquidity, both in terms of the relatively well-known benefit outgo, but also in terms of unexpected calls on cash. So for example, transfers out, or potentially if the plans of the scheme change, maybe thinking more in terms of having some money for buy-ins, but also liquidity in terms of the other things that are going on in the investment strategy. If the scheme is using LDI, considering the liquidity needs of those LDI positions is also very, very important. And then finally, in terms of return, as Neil said, it doesn't need to be a zero risk approach, but it should be consistent with the long-term funding objective, which is for most schemes around gilts plus a half discount rate. So you're looking to generate really an incremental return over gilts rather than looking to sort of shoot the lights out across the entire asset base. Now, the regulator helpfully sets out a sort of classification of different types of low dependency solutions, just as an illustration, and this is not an exhaustive list, but the three approaches that they very briefly describe are cash flow driven investing, credit based, and barbell. And in the next 10 minutes or so, I'm going to spend a little bit of time talking about the first two of these approaches, which broadly might fall under what is often called CDI, or cash flow driven investing. Rather confusingly, that can include both credit based and cash flow driven strategies, as the regulator calls them. So just to compare and contrast these two strategies, cash flow driven investing strategies are based on a very simple idea, which is you take your liability profile, which is shown on the left of the chart here. You first of all buy corporate bonds to match a very high degree of those cash flows. So the coupons and maturity proceeds from those corporate bonds and any other sort of income generating assets align very closely with those liabilities. And then you use some of the tools of LDI like gilts and swaps to basically fill in the gaps. So particularly at the long end when there are less corporate bonds in issuance, but also things like inflation hedging at the shorter end where it's not possible to own corporate bonds that provide a high degree of inflation protection, certainly not in the market at the moment. Now, credit-based strategies are the other way around. The first thing you do is you use LDI assets, in particular gilts, to cash flow match your liabilities as much as possible. And it's usually possible to achieve a very good match for liabilities using those instruments. And then you use the techniques of LDI, like things like using swaps and repo, things that can generate effectively additional capital that you can then use to invest in credit. But importantly, the credit is just there to generate your additional risk-adjusted return, just to that additional 0.5% in a way that's as most efficient as possible. We're not buying the credit to cash flow match. And that just frees the investor up a little bit more to choose different parts of the credit market. And then I'll talk about what that means a little bit later on. So cash flow driven investing, why would you as a scheme consider a cash flow driven approach? Well, it really comes down to one thing, which is reinvestment risk. Essentially, if you can buy a bond that is going to deliver cash flow to you at exactly the right time in terms of when your benefits are due, and that bond doesn't default, then you know in advance what interest you're going to get from that bond. So you've effectively eliminated the risk of not paying that benefit payment. Now, the flip side to that is you invest in a bond where the timing doesn't match the benefit payment. Now, that might be the most high quality bond in the world, but if it hands you back cash after 5 or 10 years and your benefit payment is not due for another 5 or 10 years thereafter, you've got to find somewhere to put that money. And you don't know now what interest rate you're going to be able to get in 5 or 10 years' time. So you've got what's known as reinvestment risk. And that creates some uncertainty around the eventual ability to pay that benefit payment. But the thing with CDI is that, or cash flow driven investing approach, is that you've immunized or you've eliminated that risk. Now, the thing to remember with cash flow driven approaches is that it's dealing with a very specific type of long-term risk. Volatility is a different kind of risk, and it's really important to consider this. And that's what we illustrate on this slide here. What we've shown here is the month-on-month returns versus gilts, which is roughly a proxy for a pension scheme's liabilities, of longer dated credit and shorter dated credit. Now, if you're going to be cash flow matching your liabilities, which have a duration of 20 years for many schemes, you're going to be invested in longer dated credit. And what you can see is just how much more volatile those longer dated corporate bonds are compared to shorter dated corporate bonds. You can see the bigger losses in 2008, and indeed more recently this year during the COVID crisis, big drawdowns. So as a pension scheme, you need to be able to understand that additional volatility and also probably look beyond it.
Right, so I'm going to interrupt you for a second, John, with a question, use my chair's prerogative. Does volatility really matter when you can discount your liabilities using a credit-based discount rate? Doesn't this just immunize the funding level against volatility from the long-dated credit?
I mean, it's a very good question, and it's one that we often encounter. You're absolutely right. If you discount your liabilities using a corporate bond yield, those liabilities will behave in a way that's very similar to the corporate bonds in your cash flow driven investing approach. And that will, on that basis, immunize you against funding level volatility from that spread risk. But the key thing is what does that mean in terms of your overall risk? Now, just because you're immunized on a corporate bond basis doesn't necessarily mean you're going to be immunized on a PPF basis or a buyout basis. So it's very important to consider the sponsor covenant within that. And actually, Neil, I'd be interested to hear what the regulators take on that particular approach. Is that sort of immunization approach something that you would take into account in your framework?
Yeah, so that's kind of an interesting point as well. I mean, I think that would definitely fall into a bespoke approach if a scheme decided to go into that. I mean, fundamentally, I suppose corporate bonds are a great asset class, right? Because they do provide some additional return, but also, a kind of a matching profile. But I guess from a regulator's point of view, we don't see them as risk-free. And therefore, I think just discounting them with the value of corporate bonds kind of can mask some of the things that go wrong with corporate bonds. And we've perhaps seen that in the COVID crisis and the financial crisis, with potential defaults increasing. So definitely yes to corporate bonds being part of an asset allocation. But I guess a question mark of whether it's always right to discount with in relation to a corporate bond yield for funding purposes.
Right. Thanks very much. Thanks very much, John and Neil.
Thank you for the question. So when we're designing that corporate bond strategy, bearing in mind these are things that we're going to be buying and we're going to be holding on to them for a long period of time until those benefit payments are made, we need to look for certain things. We've got to make sure that that bond is effectively worthy of that buy and maintain buy and maintain sort of label. So we're going to be looking at things like reliable management, very stable strategy. We don't really want to be investing in lots of very cyclical sectors that are going to be very vulnerable to changes in the fortunes of the broader economy. And also we're going to be looking at things like ESG as well, environmental, social and governance issues, probably with more scrutiny for these sorts of portfolios. And I'll say a little bit more on that later on.
Very good. So, oh, sorry, you have another slide.
Yeah, sorry, no. Yes, so there's a little bit of a lag on my computer there. So just to kind of round off this section on the cash flow driven approach, just to think about what that portfolio looks like when we put it all together. So here's an example. This is one of the funds that we are actually launching next month. So you're going to be seeing a global portfolio. Because you've got to match those cash flows, there's only so much you can do with sterling denominated corporate bonds. So you're going to see some dollar denominated and some euro denominated. You're going to be hedging those back though. You don't want that currency risk in there. And you also, it's the wrong kind of interest rate exposure in those bonds. So you need to bring those back to sterling interest rates. So you've got to allow for the cost of that hedging when you're doing the portfolio construction. Just looking in the bottom left here, you're probably not going to want to match every single cash flow. Rather, you're going to look at it in buckets, because if you try and match every single cash flow, you really are tying your hand behind your back. And really, you might find yourself getting into problems trying to match a particular cash flow and buying a particularly unattractive bond. So a more pragmatic approach is certainly something that we think is a bit more sensible. And then finally, one thing you're not going to be able to get away from in this sort of cash flow driven approach is a concentration to utilities. It's just a fact of life that within the corporate bond market, the longer dated credit tends to be more biased towards utilities. So you should expect to see probably around 25% within utilities in that portfolio. So you've got to be careful about how you manage the concentration risk within that utility bucket. So you don't want to have lots of exposure to a single regulatory regime. You don't want to have lots of exposure to, say, oil companies that are going to potentially be vulnerable to some of those sort of climate change risks over the medium and long term as well. So that's all I was going to say on the CDI, or cash flow driven investing approach. So Rachel, did you have a question at this point?
I did, and I wanted to invite everybody else to ask some questions. I see a couple trickling in, but I'm inviting you. We have the regulator, we have an expert on low dependency investing, so I encourage everyone to just have at them and ask your toughest questions. I'm going to start with one. John, which types of schemes do you think should be thinking about this, about low dependency the most?
I think it's going to be on the radar for all pension schemes. I think that's the reality. But if I had to have a kind of a checklist of things, I'd be looking at my maturity profile. I think if you've got a maturity profile of maybe 16 or 17 year duration rather than say 20 year, probably more urgent. Your funding position. If you are well funded on a sort of buyout type basis or self-sufficiency, as it was known, type basis, then now maybe it's the time to think about some of this de-risking as well. So those are the sorts of criteria, I think. Just before I move on to the credit-based approach, I just wanted to say one more thing about the cash flow driven approach, and that's on the LDI side, which I didn't really touch on. There is a really important job here, which is filling in those gaps. There's only so much hedging you're going to be able to get. And if you are looking for a very, very high hedge ratio in terms of your interest rate risk and inflation risk, there's some work to do. So you're relying on your LDI manager to buy those instruments to fill in some of those gaps. And that's what we've just illustrated in these charts. So here you can see the contribution to hedging from credit. On the interest rate side, you're going to need to put some LDI in over the top there. And then also on the inflation side as well, where you're not going to get any inflation hedging from the credit. Also, the contribution to hedging from credit is going to change over time. As the value of those bonds goes up and down, the interest rate sensitivity changes as well. So you've got to manage this gap filling actually dynamically. It's not really a fire and forget strategy. And then finally, it's that liquidity point. These LDI assets require cash collateral to be posted for them. If there is a cash call, where's that going to come from? Ideally, you don't want to be selling your corporate bonds to do that. You want to have some sort of integrated approach that means you can be really clever about where you source that liquidity from. Can you take it, for example, from the coupon and maturity proceeds from the bonds rather than selling the bonds. And if you really do have to sell the bonds, which bonds are you going to sell? You don't want to sell the long ones necessarily. You probably want to sell some of the shorter ones where the dealing costs might be a little bit lower. Now, quickly moving on to the credit-based approach. This is in many respects more straightforward because the corporate bonds, we're kind of on familiar territory here. We're just buying corporate bonds because we want the best risk-adjusted return. Now, where do we think that can be harvested? Well, we refer to it as the sweet spot. And what that means is that if you want to generate an additional return from corporate bonds, you can either lend to a company for longer, which is along this axis. You can see the additional spread you get goes up as you increase the maturity profile, or you can come down the credit rating spectrum into slightly lower rated bonds and earn a higher spread that way. Our view is that you should do it this way. You should come down the credit rating spectrum. The reason for this is that there are just a lot more opportunities there for a manager to exploit. An example is that in the space where investment grade meets high yield, lots of people are forced to only invest in investment grade, particularly passive index tracking funds. So when a bond does get downgraded to high yield, to that, say, BB point, sometimes because of that forced selling, that bond can be really quite attractively priced. And often what you see is quite a lot of management action because the management of that company are desperate to get it back to investment grade. So you see these sort of so-called fallen angels come down, get oversold. Managers can come in that are more actively managed to take advantage of that. The bond then gets upgraded. That manager then benefits from the price increase in that as well. In terms of the guidelines, what are we going to see for this sort of portfolio? Objective of, as I said, returns rather than cash flow matching. Probably still going to be a global portfolio because that's where we want as big an opportunity set as possible to harvest those opportunities. Duration of 3 years because we'd rather take the risk by coming down the credit rating quality a little bit. Still mainly investment grade, but maybe 20% in sub-investment grade. We probably don't want to go lower than BB rated, bearing in mind that regulator requirement for high quality. And then a really highly diversified portfolio as well. We don't want to have lots of concentration risk in single names and sectors. So in practice, what are the things that schemes should consider? I've mentioned ESG a couple of times. Why is this so important? Well, it's pretty straightforward. I mean, climate change is a really long-term risk with huge consequences. And changing course within particularly a cash flow driven approach can be very expensive. We want to hold these bonds to maturity. We don't want to reintroduce that reinvestment risk because the bond has defaulted or because we've had to sell it because something has changed. So we have to pay really close attention to that. And also regulation can change. You've already seen action from the regulator to increase disclosure on ESG policies and climate resilience. That may change and grow in the future. We want to be resilient to that as well. So how can schemes do this in practice? Well, larger schemes will often favour bespoke approaches or maybe segregated approaches where they can have a high degree of tailoring, maybe introducing some of those alternative sources of yields like infrastructure, like on the question earlier on. For smaller schemes who perhaps don't have the governance or the fee budget to use that bespoke approach, the good news is that there's really been a real explosion of innovation and solutions out there in the market to help schemes manage that low dependency journey. We have sort of hybrid type approaches that combine the credit and the LDI in sort of ready to go pooled funds. And also there are building blocks, so standalone credit and LDI funds that can be used for sort of more DIY approaches. And of course, you know, different levels of delegation are possible as well. You know, if you do go down a fiduciary route, you should expect these sorts of conversations to be taking place and for your fiduciary manager to have solutions lined up and ready to go for low dependency. So finally, just to sum up from me, there's no one size fits all to low dependency. It's a bit of a cliche, but it is true. I think the regulator is absolutely right to highlight that there is more than one approach. It may mean that for some approaches, you need to go down the bespoke route rather than the fast track route, but I think for schemes, you can think about your own circumstances and there is sufficient flexibility there to tailor that. There are some specialist skills required to do low dependency. It's not necessarily in the wheelhouse of all traditional asset managers, particularly cash flow driven investing. This is not a traditional credit based approach, and the LDI techniques as well can be quite specialized as well. But the good news is that there is a really wide range of solutions out there to help you manage these challenges, both in terms of bespoke solutions, but also pooled funds. So that's all I was going to say. Very, very happy to take more questions.
Fantastic. Thanks, John. To give you a bit of a break, we had a question come in for Neil while he was speaking the first time. Neil, is TPR willing to accept that different schemes will have varying covenant structures, and as such, one size fits all cannot really work?
Yeah, so that's a good question, and thank you for that. So let me answer that in a couple of different ways. First of all, we do think that covenant rating is an important part of the regulatory sort of regime going forward. In fact, that and maturity. So we would, for an average maturity scheme, be happy to have a higher level of risk for a scheme that's got a higher covenant than one that has a lower covenant, all other things being equal. Having said all of that, once a scheme gets to that significantly mature point, which might be in 15 to 20 years' time, we do want all schemes, regardless of their covenant, to be in kind of that safe harbour. And the reason for that is because schemes at that point are often paying out quite significant amounts of their fund in cash, in pensions. And also, even schemes with very strong covenants can find themselves in a tricky position in a relatively short period of time. And unfortunately, we've seen that sometimes with the COVID situation. So absolutely building in covenant to that regime. But in terms of that end game strategy, we do want all schemes, regardless of their covenant, to plan to be in a low risk, high resilience to risk position when they're significantly mature. And as John mentioned, that for many schemes, that's 15 to 20 years time, but you don't want to leave it to the last minute. You want to plan for that now and get yourself on the trajectory that will get you there. And that's very much about that message that we want from us as a regulator to get to pension plans.
Right, great. And John, how are your clients fitting into these various approaches?
So we're seeing a range of different approaches, and I think a lot of it does depend on the starting point. I think if a client has an LDI strategy that's maybe got a combination of leveraged approaches and unleveraged approaches, then clients are often thinking, well, can I take just a quick step to basically flip some of that LDI into a low dependency type strategy, maybe a cash flow driven approach, and build up the journey from there. But I think it does vary, and certainly it's something, as I sort of alluded to earlier, that more mature schemes are paying more attention to, and better funded schemes are paying attention to.
Yeah, great. And as a firm at BMO, what new developments are you making in the light of this?
Well, we've traditionally served sort of both large schemes in bespoke approaches, but also had quite a lot of different solutions for small and mid-sized approaches. And we've been managing bespoke approaches in this space for probably about 10 years now, but we've not necessarily had anything off the shelf for those schemes that want something a little bit more easy to implement. And that's what we've been focusing on the last year or so. So in the next month or so, we're going to be launching a range of low dependency pooled funds that both cover the cash flow driven approach, but also the credit based approach that the regulator has alluded to.
Fantastic. And Neil, what kind of things are the regulator hearing from schemes? If you want to give us sort of a mini FAQ, that would be great.
Yeah, sure. So, we get a lot of questions back, and the consultation has kind of triggered that. I mean, I guess if I could just hit a couple of the ones that are most commonly asked. I mean, some schemes want, if they're going down a bespoke approach, to really be sort of treated totally separately from the fast track reference point. I think we say in the consultation that although we're happy for schemes to go down the bespoke route, we will measure their risk in the first point relative to where they are on fast track. And that's kind of a controversial point that some people have a range of different views. From a regulator's point of view, that's quite a simple reason for doing that. We do need a kind of objective, measurable benchmark to look at all schemes. And under our proposed regime, that's fast track. That doesn't mean everyone has to follow fast track, but clearly somebody who is running investment risk of a fraction over fast track, compared to one that's running 3 times the level of risk, it makes sense for those to be treated differently when we look at their evidence under bespoke. So that's the first one. I guess the other one is about how to measure risk. And I think a lot of people have sort of welcomed a use of a stress test, but some people have raised the concerns that maybe it's too simplistic, maybe it doesn't cover the risk in their pension plans. And it doesn't align with perhaps the way they measure risk. And I guess from a regulator's point of view, we would answer that in this way. I mean, again, we want an objective way of measuring risk. We don't want to spend our time going into individual models of clients and looking at exactly how they measure risk, because you can have 2 pension plans with exactly the same liabilities, exactly the same asset, and those spit out different numbers from a risk perspective. That doesn't work for us as a regulator. We do need to have that to be objective. We also need it to be quite simple. There's an awful lot of schemes that are quite small, with less than 100 members. And we're very keen that we don't increase regulatory burden too much. So it's trying to find that compromise. And we think the stress test is a you know, for all its frailties, and and clearly it is a fairly simplistic scenario, but I think that achieves the right balance between looking at risk in an objective way and being relatively simple to apply. The other point around that is, with that in mind, we do propose to use the PPF stress as a starting point. That's something that many pension plans are already using, they're familiar with that. And we didn't want to be in a position where schemes are having to sort of do 2 stress tests, one for the PPF and one for ourselves. So that is an important one as well. So I think they are the kind of key things that we get questioned on from a regulator. And yeah, hopefully that's given you a flavour for kind of how we think about those issues.
Right, thanks so much. And John, I noticed in your presentation that it is largely a credit-based strategy. Are your clients more nervous about credit investing, just in the light of COVID-19 and what's happened to markets?
I think what our clients are certainly much more cognizant on is liquidity, because actually what we saw in March time was some quite substantial liquidity calls from LDI assets, because interest rates were rising. They rose quite rapidly and then came back down again. But that created some cash requirements for LDI assets. But we also saw, particularly at the longer end of the credit curve, we saw it become much more expensive to buy and sell corporate bonds as well. So I think it's that focus on liquidity that's become much more important for clients. And what that means is that those sort of hybrid approaches that combine LDI and credit in single portfolios we think are actually probably more resilient to that sort of liquidity type of challenge than, say, an approach which just sort of combines a credit pot and an LDI pot.
Right, interesting. And Neil, just to be devil's advocate here, there's so much happening, in the world. We've got another 6 months of the semi-lockdown yesterday. Is this really the right time for a new regime? Shouldn't regulator wait for COVID to pass?
Yeah, that's kind of an interesting one, and we've had that question a number of times. I think there was a survey before COVID, and it kind of asked people in one of the seminars we did, do people support a funding code? And that was overwhelmingly positive. We did a same survey during COVID, and that number had come down a little bit, which kind of is to the heart of your question, I guess. I suppose from a regulator's point of view, we do think it's appropriate. And in fact, I would probably go stronger than that. We think that, unfortunately, the events of the last 6 months has shown us, that the code is even more important, actually. And if we go back to kind of the white paper that launched all of this by the government, it basically said that the existing DB funding regime worked quite well, but there were abuses of flexibility at the extremes. It's kind of worth remembering that, and that's the premise really that we started the funding code in. And we have seen that during this crisis. You know, the schemes that have thought about many of the issues that John highlighted, the degree of hedging, you know, taking that sort of integrated risk approach, looking at their levels of downside risk and protecting that, have actually fared pretty well during that crisis. The schemes that perhaps haven't done that so much or haven't focused on that have been hit quite hard from a funding level perspective, mainly as a result of a fall in interest rates and bond yields. So, you know, we want, ultimately, you know, one of our objectives is for pensioners to receive the promises that they've been made, and getting everybody into that kind of safe harbour, whether it be in funding or whether it be in investment strategy, is really a sort of central tenet to what we're doing. And I would probably, as I say, go as far as to say that's more important post-COVID than it was pre-COVID. So from a regulator's point of view, it's very clear we're not pausing the code. We did pause the consultation to give people a little bit more time as they were reacting to COVID. I think that was right and proper. We pushed that back by a few months, but we do plan to press ahead with this, and that's true also of the pensions bill in Parliament. So that's our keen desire to implement some of the things we talked about today.
Right. Fantastic. And John, from your perspective or your client's perspective, there's an awful lot happening. I'm just wondering, what are you doing to educate clients? And this webinar today, I hope, is a great start. But, you know, what kind of other activities are you putting together for your clients and prospective?
Yeah, I mean, this is like a really big deal for us. It's a really hot topic for us. So as well as this webinar, we're going to be releasing a series of articles over the next 2 or 3 months covering off some of the issues as well. But also just really keen to talk to clients as well about this. I mean, personally, I'm really sort of passionate about this as a topic, and we'd be delighted to talk to clients and try and sort of help you with some of your specific issues.
Fantastic. So that's all we have time for today. And I'd like to thank everyone who joined us today. There were quite a lot of you. And of course, Neil and John, thank you very much for your hard work, and our colleagues at BMO and the PLSA who helped put this together. We hope to see all of you soon. And that's us for now. Thank you very much, and we'll see you soon. Bye.
Thank you. Bye-bye.